Right. Hello, students. Yeah. Hello, students. So previous classes, I explained about the financial services. So fund-based services and fee-based services. So already we discussed some topics in black 1 and black 2. In black 1, whatever the services provided based on the fund-based services. In black 1, fee-based services. In black 1, second unit already I explained. So last class also I explained in black 2 regarding the regarding the that hire purchase, and before hire purchase of that I explained, that is yeah yeah before hire purchase I explained leasing also. In black 2 there are 3 units. First one is the leasing financing related topic. So next one is the hire purchase. Third one is the venture capital. So if I explain this venture capital, that third unit black 2 is over. So what is the meaning of venture capital? And what is the meaning of venture capital? How we are going to identify? What is the features of venture capital? So that all the details today I'm going to cover. What is the advantages and what is the features and importance of venture capital, types of venture capitalists. So that all are I'm going to explain. So first I'll explain what is the meaning of venture capital. Nowadays venture capital is very popular. Global wise, we reached 248.4 billion up to 2023. These venture capital funds are scale disruptive innovations and growth driven in the business models. So, what is the meaning of venture capital? Venture capital is a investment which is invested in high risky projects and high rewarded projects. So that is called as a venture capital. So what is the meaning of venture capital? Yeah. Venture capital is a risk capital financing in high technology projects. So which involves risk, but at the same time, strong potential for the growth. In venture capital means funds made available for the startup firms and small business with the exception growth potentials. So here simply you have to understand that venture capital is a long-term financing which is going to provide and which is going to involve in the high risky and high rewarded projects. So this investment focus on the startups with the strong growth of potential. So the aim of this venture capital, equity ownership aim to achieve the substantial financial returns via shares. So it is launched, this venture capital is started after Second World War. So still it is continuing. So this is the meaning of venture capital. So venture capital means simply it is a long-term source of financing and which is going to invest in the high risky projects. So I'll explain definition also. So venture capital defined as it is a equity support to fund new concept that involve high risk and at the same time high growth and profit potential. So this definition is given by the SEBI. So what is the features of venture capital? What is the features of venture capital? Generally, already I explained that simply, uh, generally this venture capital is having high degree of risk, first of all, and equity participation is more, and it is long-term investment pattern and participation in management and achieve social objectives and investment is liquidate and superior product development opportunity for the research and universities and laboratories. So generally, these all are the features of venture capital. So first one is what? High degree of risk. So in the meaning itself only I explained it is. So whatever the venture capital finance is there, venture capital is there, it involves very high risk because we are going to invest in the startups and we are going to invest in the innovation projects. So if the project is fail, so our capital also we are going to lose. So that is the reason it is a high risky project. Second one is the equity participation. Venture capital financing is invariability and actual equity participation, whether object of venture capital is to make the capital gain by selling of shares from become a profitable. So generally in this venture capital, equity shareholders can involve more and they can, whenever they required, when they want to buy, they can buy and sell done in the market. Next one is the participation in management. In addition to providing the capital, venture capital fund take the active interest of in the management. So the approach of venture capital forms different from the traditional leaders or bankers. It is also different from an ordinary equity investor who merely trade the shares company without participation. Generally, we are going to observe investor those who hold the equity shares, they doesn't participate in the management. But in venture capital, they can participate in the management decisions also. So, and also it is social objectives. See, for the purpose of development, capital provided by the savers, several central and state level government bodies. So to develop the economic and infrastructure facilities and to provide the basic facilities also, the government will provide. But venture capital projects generate the employment because when the project is startup, when the any startup is there, if they started that with the help of venture capital, once they started the project, automatically they are providing employment also. So that is also one of them. So investment liquidity. Venture capital is not subject to repayment on demand. So here, when we invested, when we want to liquidate our money, it cannot possible in the venture capital. Sometimes we have to wait for a long period of time also. And investment, next one is a opportunity for research and development. This venture capital maximum going to be involved highly research and development projects only. So that purpose we are going to use. So generally here I mentioned some of the features. It is a long-term and high-risky project, active involvement. Venture capital provide the monitorship and strategic guidance and sector focus, specialized in tech and biotech, healthcare are more focused. They are going to focus these areas and equity stake. Venture capital firms owns the significant shares of startups. So these are the features. What is the importance of venture capital? What is the importance of venture capital? Generally, this venture capital will help to promote the entrepreneurship, first of all. This is the very important point. Second one is promote the product. Next one is encourage the customers. Next one is bring out latent talent. And next one is the promote the experts. And next one is as a catalyst. And next one is the bring the financial viability, helps to technology growth, helps for the sick companies, and create more employment opportunities. So this is the very important factors which we have in the venture capital. So here they are promote the entrepreneurship, means bridges funding gaps. Say when any entrepreneur they want to start the any business, so it is very difficult to do raising of capital. So that situation, this venture capital will help to entrepreneurs. And next one is the experts and networks. So here promote the products, venture capital with the participation, very professionals and experts. So accelerate the growth through the advisory and industry contacts. And next one is the encourage the customers. Venture capital firm provides funds their customers, not mere the financial assistance, but more as a package deal, which is include the assistance of management, marketing, technical, and other side also. So promote the exports, whatever they produce it, to export that, they are going to get the basic facilities also. So these all are the venture important factors of venture capital. What is the type of venture capitalist? Generally, venture capitalist we classified into three categories. First one is the angel investors. Second one is the corporate venture capital. Third one is the independent venture capital firms. So angel investors means wealthy individuals funding seed round, and typically investment $25K to 1 lakh dollars. So corporate ventures. So corporate ventures investment owns large corporations. Examples: Google Ventures, Intel Capitals. So these are the examples for the corporate venture capitals. Independent venture capital firm raise capital from institutions. Raise the capital from institutions. Examples: Anderson, Harvard's, Kellner, Hawkins. So these companies are independents of venture capital. So venture capital, generally, we have three types according to our syllabus. So that is organization venture capitals or institutional venture capital funds. When venture capital funds set up by the angel investors, that high network individual investors. So next one is the venture capital subsidiaries or companies. So these are established by big corporations. It is nothing but a corporate venture capital. Next one is the private firms or funds. So primarily investment, institutional sources of venture capital is venture capitalists take the high risk by the investing from earlier stage. So these are the various types of venture capitals. And modes and financing of investment stages. Yeah, modes of financing venture capital. Yeah, Venture capitalists provide the funds for the long term in any following of modes. So maybe they will provide as a equity, maybe they will provide as a conditional loan, or maybe they will provide convertible loans. What is the equity? What is the conditional loan? And what is the convertible loans? This mode of financing by the venture capitalist, three ways they are going to provide the loans. First one is the equity. So equity is nothing but the shares exchanged for the capital investment. Most of the venture capital funds provided financial support and entrepreneurs from equity financing, 49% of the total equity. This is to ensure that the ownership and overall control remains with the entrepreneur. Since there is a greater uncertainty about the generation of cash inflows in the initial years, equity financing is the safest mode financing. A debt instrument, on the other hand, requires the periodical servicing through the payment of interest. But in equity side, this type of payments doesn't require. So this is the first mode of finance in the venture capital. Second one is the conditional loan. Conditional loan means what? From a venture capital, a point of view, equity is unsecured instrument and hence less preferable option than the secured of debt instruments. So here, a conditional loan usually involves either no interest at all or a coupon payment at nominal rate. In additionally, royalty at agreed rates to payable that lender on the sales turnover. As the unit picks up in sales level, the interest rate are increased by the royalty amount are decreased. So conditional loans means what? When they are entering to the finance agreement, so before only they are going to write a agreement. Whether they want to, when the investor, when is expecting any royalty, are based on the proportionate profits on their profits of the projects or periodical interest. So these all are based on these conditions, they are going to provide the loan. So that is the conditional loan. Next one is the convertible loans or convertible debt. So debt converting into the equity. So these convertible loans is subordinate to the all other loans, which may be converted into equity. If interest payment are not made within the agreed time limit, generally these loans can be converted as a equity. After conversion of this equity, whatever the equity shareholders having that all the rights having by the these convertible loan providers also. So this is the convertible loans. Next one is the investment stages of investment. See, stages of investment generally there are different stages we have. So what are the different stages we have? First one is the venture capital funding is procedure gets the complete in 6 stages. Financial corresponding to the period of company development. So first one is the seed money. What is the meaning of seed money? Low level of financing provided for the fructifying of new idea, provided in the initial stage for setup of the enterprises by the entrepreneur. So here, seed money means what? It is a low level financing providing for fructifying of new idea. So generally, when we have an idea to develop that, whatever the amount we invested, so that is nothing but a seed money. Startup. What is the meaning of startup? The second, it is startup is the second level of stage of investment. So startup means what? The funding is required for the making and marketing of the desired and designed product. So whatever idea we developed in the stage one, to do the marketing and marketing, whatever the funds we required, that is the startup stage. The new firms needing the funds for the investment into marketing and product development are provided by the venture capital funds. So here seed money means already we know, startup means already we know. So here first round, the venture capital firm invest the process of manufacturing, early sales enable to entrepreneur take off the farm's operation. In second round, the venture capital funds come in the form of operationals. The capital given for the early stage companies which are selling the product but not earning the profit on account of improvement of scale economics. Third round, this is the money for the expanding the newly beneficiary company. Fourth round, also called bridge finance. Fourth round is proposed for financing going public process. Once the farm goes public, the venture capitalist slowly, steadily uploaded their shares in the market process of disinvestment. So that is also. So here early stage financing, expansion financing, other than this investment, other than these rounds, early stage financing, expansion financing, acquisition or buying financing. So these are in different stages also there. So early stage financing means what? The financing three subdivisions, again early stage financing also. That is seed financing, startup financing, and first financing. So whatever I explained previously, that only for development of idea, for the startup, the marketing purpose and expansion purpose also. Next, expansion financing. So expansion financing may be categorized into second stage financing, bridge financing, and third stage financing or mezzanine financing. So second stage financing, what we are doing, it is going to provide the companies for the purpose of beginning their expansion. It is also known as a measuring financing. It providing for the purpose of assessing for the particular company, expanding major way. This bridge finance may be provided for short-term interest only. The finance option as well as form monetary assistance for the company that employ the initial public offer of major finance business. Acquisition or buyout the financing. It means this category is into acquisition finance and management leveraged buying finance. Acquisition financing is assists that companies is acquire the certain parts or entries of the enter of the company. Managed or leveraged buyout financing helps to particular management groups opening the particular product or another company. So this is the different stages of the this is the different stages of the venture capital investment. Next one, factors affecting investment decisions. Factors affecting investment decisions. That is, first one is the generally strong management team required. Here, management team is factors affecting. So, management team experience and capability leadership is must for this. This management team really factors affecting for the investment decisions. And next one is the competitive advantage, unique technology or innovation business models. So that is will give the competitive technology. And next one is the financial projects, realistic and achievable revenue goals and market opportunities. So these all the factors are going to affect. So additionally, there is some more factors affecting investment decisions. That is strong managed team, a viable idea and business plan, project cost and return, future market prospects, existing technology. So these all are going to be affected. Next one, selection of venture capital. Selection of venture capital. See here, selection of venture capital, we are what we are going to do for the selection of venture capital, hands-on, hands-off approach. So it means what? The hands-on style, the hands-on style managed will normally involve representation on the board. It would be involve very active interaction between the entrepreneur and venture capitalist. An attempt is made, valued, added services. The advisory role, active involvement in the marketing, recruitment and funding technology collaborators. It will be kind of active participate between the two. So hands-on, hands-off approach means there are two parties can involve, that is the entrepreneur and venture capitalists. So there are very active interaction between the entrepreneur and venture capitalist. An attempt is made for the value added services. Value added services means what? So they are going to provide the advisory role, at the same time active involvement in the marketing, and they are going to involvement in the recruitment of funding technical collaborators also. So this is hands-on, hands-off approach. So those who are providing the venture capitalists, they will provide the add-on services. Next, the hands-off approach means what? So on the other hand, hands will be passive and venture capital will be just receive the periodic statement of financial and other information. There is a intermediate style where the approach is passive except in the major decisions like change top management, and it is deals with the flexibility. Entrepreneur should seek out the funds which give a package that best meet his needs, or some funds are very flexible in their matter and any surprise entrepreneur with their generosity. Others have some rigid rules. There are various approaches between these two extremes. So exit approach and fund viability and liquidity and track record of round of its team. So these all are the selection of venture capital. What is the meaning of equity? Private equity. Private equity is sometimes confused with the venture capital because the both are referred to the firm that invest in the companies existing through the selling their investment in the equity financing, such as an initial public offer. However, there is some difference also there. The way of involved. The private equity venture capital buy different types of sizes of the company, invest different amounts of the money, and claim different percentages also. Percentage of equity of the company which they invest. Private equity is a part and component of alternative investment funds. So alternative investment funds, private equity is the separate fund. So as per definition of SEBI, regulations of SEBI, private equity funds are category 2 investments. It includes various types of funds such as a real estate funds, provided equity funds, funds for the distressed assets, etc. These are registered category 2 AIF. One important characteristic that features of these funds, that is, which do not undertake the leverage or borrowed other than meet to day-to-day operational requirement and permitted in the SEBI. What is the meaning of private equity? Private equity is the equity shares which will not publicly listed or traded. Private equity is a source of investment capital that comes from the high net worth of individuals or forms. These investors buy the shares of private companies, gain control of public companies with the intention of taking the private ultimate, delisting them public stock exchanges. Large institutional investors dominate the private equity world, includes pension funds, large private equity funds. So simply, I can explain the meaning of private equity. So, what those equity shares which not traded in publicly. So, this private equity collected from the particular institutions and particular valuable investors. So, that is called as a private equity. So, this is the story about the venture capital. I conclude that venture capital means what? Venture capital financing is a long-term financing, which means the amount invested in the new projects, innovative projects, and these projects involves very high risk. At the same time, the project will provide high rewards for the investors. So that is called as a venture capital. Next, next one is right. Yeah. Next chapter is Unit 7, that is factoring. What is the meaning of factoring? The term factoring has originally, it is actually Latin word facer, meaning to make or to do. That is to get things done. So simply, factoring may be defined as a continuing arrangement between financial institution or bankers and a business concern selling goods or providing services on credit, where factor undertake the risk of the recording, collecting, controlling, and protecting the books of debts. Debts also purchasing the bills receivables of the supplier. So simply, we can say that factoring means yeah, factoring is a financial transaction where the business sells account business sells it is account receivables to third party called factor at discount. It is used as a short-term financing tool for the improving the cash flow, widely used by the small and medium enterprises. So, uh, factoring evaluation. See, factoring evaluation, this is an ancient origins. Factoring begins in Mesopotamia around 2000 BC. And in 17th century, in England, modern factoring grew with the trade expansion in England. And in the 19th century, the textile industry boosted the factoring, popular across the America. And in India, introduced in 1990, regulated by RBI and governed under the Factoring Regulation Act 2011. And in 21st century, technology and globalization expanded factoring markets worldwide. Now, market size of this factoring around 3 trillion global markets up to 2003 only. So this is the evaluation of factoring. How does it work? How it is going to be work factoring? Generally, first step, client deliver the goods, services and issue the invoice. The invoice submission, client submit the invoice to the factoring company for the review. First step. After that, client sell the invoice to a factor. So then factor pays 70 to 90% of invoice value immediately. Customer pays the factors on due date. So next one is the customers pays the on due date. Factors pay the remaining amount to the client, less fee charges. So here it means what? First, what happened? Seller can sell the product to the buyer. The buyer can approach the factors. So here, once the invoice is submission, verification will done. The factors verify the invoice legitimacy and client credit. Next, advance payment. Factor advances typically, 92 advance payment. Factor advances typically 70 to 90% of the invoice of collection. Then factor collects the payments directly from the customers. The balance remittance, remaining amount paid to the client minus factoring charges. Simply here, only we have to remember, that is generally financial institution involved and banker involved and business concern involved. So whatever the financial institution provided that a loan for the business concern, they're going to provide. After that, banker can act as a factor. So whatever the financial institution amount they are providing financial institution or banker, the business concern, selling of goods. So generally, banker will provide the amount for the behalf of company, and after that, banker can recollect the customer and repay to the institution. And for doing of this, certain charge they are going to be charged. Here, first, I will explain that with the help of one diagram. I will share also. See, here I shared here. The following diagram clearly show that mechanics of factoring option. First, what happened? First, foremost, the buyer places an order with the seller expressing his desire to purchase the goods. So, buyer, first he will do to the seller. He will explain to him to buy a to desire to purchase of goods. Second one, on obtaining of the order, seller send the details of the buyers to the factors. So what happened? Sellers can send the details of the buyers to the factor. The buyer, the factor together come, buyer and factor together come, decide credit limit to be for the set of the particular buyer. So here, when the seller send the buyer details to the factor, this factor will approach the buyer and it decide the his limit, how much credit limit approval for the buyer. So they entered into the memorandum understanding agreement also. After getting credit approval from the factor, after getting approval from the factor, the seller raises the invoice and deliver the goods to the buyer with the notice of stating the payment has to be made to the factor. So what he is going to do? The seller can send the goods to the buyer and he will give the notice for the factors also. Supplier will send a copy to invoice to factor. Supplier means here. They will send a copy to the factor and the factor then pay up to 80 to 85% of invoice amount to the seller. So factor can pay the amount to seller. This one. Next, the factor perform regular follow-up of the collection from the various buyers, make necessary arrangement for the collecting dues. So this factor can approach the buyers and he will be regular touch with the buyers. He can collect the dues from the buyers. And the factor also send monthly statement transaction to the buyer. Once the amount is realized on the due date, the factor make the balance of payment to the seller after deduction of interest. The amount remain unpaid due date. The factor recovers the same from the seller. In case of recurse factor, non-resourcing factor, respect of the fact whether due or recovered or not, factor make the final payment. So this is the process. Types of factors and legal framework. So there are different types of factors are there. Types of factoring. Notified versus unnotified. Whether customer is informed to the factoring or not. So notified means whether the customer is informed or not. And domestic work factors versus export factor. The transaction within the country or across the borders. That also we are going to check. And next one is the full factoring, old line factoring. Factor manage the entire account receivables process. Next one is advance versus maturity. The funding timing based on the invoice date for payment of maturity time or additional type of bank participation are important. Next one is the resource factoring and non-resource factoring. The credit rates burned by the client are factory irrespective of that. So these all are the various types of factoring. Import factoring and bank participation factoring. So these all are the various types of factoring. And detailed here I mentioned notified or unnotified factoring. Notified factoring means customer is informed of factoring arrangements. Enhance transparency, collection of process efficiency. Unnotified means customer is unaware about the factoring agreement. It is maintain the client discretion of but may not raise the operational risk. The key difference is risk is exposed the client relationship and impact of that. Domestic and export factoring. Domestic factoring means no currency exchange needed, aligned regularly environment, lower complexity and risks also. Export factoring means what? Cross-border transactions generally it is going to be involved internationally, and the currency exchange management also there. And compliance with the international regulations, higher credit risk and political risk also. Resource and non-resource factoring. Resource factoring means client retains the credit risk invoice go if invoice go unpaid. And non-resources factoring means factors assume that credit risk offering the greater security. And pricing impact non-resources factoring generally involve high fees. Advantages of factoring. See, advantage of factoring, there are many advantages are there. Improve the cash inflows instantly and reduce the credit risk of management burden for the financial institutions. Support the business growth and working capital. And these are the main advantages. Limitations. High cost compared to the traditional loans. Losses of the control over allocation and possibly impact of the customer relationship. Strategies. The business should be weighing benefited versus cost carefully. So these are the benefits. So this is the story about the factoring. Next class, we'll continue.